Okay, hi. So my name is Matt Pignati, and this is my application for the Fed Challenge. This presentation on inflation and the policy implications that current inflationary environment has. So right now, the current inflation rate is 1.1% annually, according to the Bureau of Labor Statistics, which is which is barely over half of the Fed's target rate of 2%. As you can see from the graph over the past 15 years, that inflation has consistently been missing the Fed's target, especially recently since the post-crisis era. Um, so, okay, so for factors affecting the inflation rate, we want to start with the stagnant economy, really. So the S&P is up 25% since 2013 and over 200% since its recessionary lows of 2009. However, this hasn't really translated into sustainable growth in the U.S. We've seen low growth rates, almost nothing for the past between 1 and 2% for the past 4 or 5 years, and even now, as we've hit the fourth year of the recovery or the fifth year, GDP growth is only 2% annually and was 3.2% in the fourth quarter of 2013. Also, the unemployment rate has dropped from its high of 8%, but it's only at 6.7%, and one third of those unemployed are of the long-term unemployment. Also, there's only a 63% labor participation rate, which has gotten much discussion of how low it is, and it's down almost 3% from 2009. And what this all goes to show is that there's no real sustainable growth, at least domestically, to put upward pressure on inflation or even on inflationary expectations, as I'll talk about in a little bit. As far as other factors that are affecting inflation, well, we have really stagnant growth worldwide, and with the exception of China and Brazil to a certain extent. Most countries are still struggling from the recessionary period. The Eurozone is just pulling out of the depths. It was still contracted by almost 0.5% in 2013, but there were positives. It did grow in the fourth quarter, I believe, by 0.3%. But the other like countries, like emerging markets in Central America and around the world, have not been doing too well recently. Also, a good indicator for the CPI is often the PPI, the Producer Price Index, and this hasn't been growing by much either. On an adjusted basis, the index grew 0.9% from February 2013 to 2014. So it's usually used as an indicator of future inflation, one of the many, and that doesn't bode too well for the Fed being able to hit its target in the future. Also, there's a lot of cash that's being just sat on by banks. There's a lot of money. The Federal Reserve has tripled the monetary base since 2009. However, the growth in M1, M2, and M3 is much lower. A lot of that is due to the banks having a lot of money with the Fed or in excess reserves. So even though they're doing quite well, a lot of that money isn't making it the into the economy, and therefore not boosting inflation, boosting prices. Another big factor when it comes to gauging inflation is expectations about future inflation. There can be a big part in driving the current numbers. As you can see, I'm going to skip ahead a slide to next one. I wasn't able to transpose the TIPS spread onto one graph, but I do have the 10-year Treasury versus the 10-year TIPS. And as you can see from both, the spread between them is relatively constant. It's about right now a little over 2%. However, the TIPS itself is getting really low return. It was negative in 2012 and 2013, and only has recently gotten up to about 0.5%. In fact, TIPS ETFs took a big hit yesterday when investors pulled 134 million out of out of them as a result of what Janet Yellen recently said about having too much slack in the labor market. Now, originally, they were put there because a lot of bets were made after Yellen said the interest rates could rise by the end of the year, and that the Fed's fund rate could rise within 6 months of QE ending. However, her more recent statements have shown just how frail these expectations about the tips and about inflation are. So the Fed has a dual mandate to both keep unemployment low and keep inflation under control. And it's been adopting a pretty accommodative monetary policy in order to do so. Right near the beginning of the recession, the Fed set the Fed or targeted the funds rate at 0% and put interest on reserves at 0.25%, basically meaning that keeping excess reserves at the Fed wouldn't gain too much interest for banks. However, there's still a lot of money there. Also, they implemented three QE programs, the third of which is currently undertaking. They're currently still being undertaken. Started off as 85 billion in purchases a month, 45 billion in long-term treasuries, and 40 billion in mortgage-backed securities. However, it's been cut twice down to 65 billion, 35 billion in long-term treasuries, and 30 billion in mortgage-backed securities. That's doing this in hopes of both boosting inflation and, more importantly, reducing unemployment, which, according to whoever you ask, they may have been successful at or not so successful. So what are the implications of this low inflation environment? Well, it would generally mean that along fiscal policy lines, the government can be more aggressive in undertaking projects and stimulating the economy because there's no need to worry about runaway inflation, at least among most people agree about that, or about high borrowing costs, meaning that investment projects can be more profitable for the government and can have a greater stimulative effect. If you look at a traditional Keynesian ISLM model, the downside of implementing some sort of fiscal stimulus is higher interest rates and, or possibly if that's downside, and higher prices. However, with such low interest rates and again such low inflation, the stimulative effect of fiscal policy would probably outweigh that, at least according to the model. Um, and since the CBO estimates that the NAIRU, which is an estimation of the natural rate of unemployment, is at 5.5%, until that target is reached, we shouldn't see rapid inflation as a result of these actions. As far as the Fed goes, the low inflation environment means that they should err more on the side of the doves, focusing more on how they can reduce unemployment than on controlling inflation, which is already anchored for the foreseeable future, according to most projections. Um, there are worries about the hawks now that they haven't gotten the high inflation that they predicted. There's worries about asset bubbles, mainly in, like, for example, the tech companies with the recent IPOs of Twitter and things, and also the explosive nature of the S&P over the past couple of years. So there's worried about asset bubbles, much like the housing bubble in 2008. However, it's really hard to gauge what exactly an asset bubble is. It also kind of convolutes what the Fed's trying to do, at least when it has the goals of inflation and unemployment. It's easy to target one or the other, and they generally work in opposite of each other. Whereas adding an asset bubble to that, it's hard to judge, first of all, and it just will make what the Fed's doing and the way it's communicating even more convoluted. So I think so the implication is that they should stop with the tapering of QE and keep the Fed funds rates at zero. I would also actually think about going with negative interest rates on reserves. Monetary base has grown 250% since 2008. However, M2, which is cash and cash equivalents and bank deposits, has only grown 35% over that time, which it doesn't seem right. More of that money needs to come out of the banks and out of the reserves at the Federal Reserve. And the ECB had been thinking about doing negative interest rates. I don't believe they did, but it could be a good way to get more money into the system and therefore in a more natural way, I guess, to boost inflation. Also, I think most importantly, the Fed needs to do a better job at guiding the market where it wants it to go. It really lacks credibility, which is why even though the market and investors do sway on whatever Ben Bernanke or Janet Yellen now say, there's really no credibility in terms of meeting their targets, and in that way they're making their job more difficult. So, for example, they're wavering on the 6.5% mark for ending QE, which is probably a good thing because of the low labor force participation rate, because of the low growth in GDP. It's probably good to err more on the side of the doves in that way, but even so, they should have more explicit targets. Maybe, for example, pairing unemployment with labor force participation, or using the more broad-based unemployment, which includes like discouraged workers and things like that. The Fed could also take up nominal GDP targeting, which was advocated by, or has been advocated by Scott Sumner, and which has been seen to be influential in their more forward-guiding recent QE program. However, if using nominal GDP as an explicit target would take into account both employment and inflation into one metric. Also, giving the Fed an explicit target which it would follow would make it less unpredictable, and it would allow, although I don't know the exact details of how it would work, it would allow for more market participation in determining targets for future growth in nominal GDP. And on top of that, the reason it became so popular, or has become so popular recently, is that it correctly predicted that money was tight even after the first couple of QE programs in 2008 and 2010, when a lot of people were predicting hyperinflation. The market monitors went the other way, and they proved to be right. I also think they provide the best example of why the Fed should be both guiding the market and keeping its foot on the gas pedal, so to speak, and not settling for what we're currently facing, which is still low growth, um, relatively high unemployment, especially compared to the natural rate, and combined with low inflation. I think the Fed is clearly, its dual mandate is clearly still favoring a more accommodative policy. Okay, so that's my presentation. Thank you for listening to this, and I hope to be part of the Fed Challenge team come next fall. All right, thank you.